So if I can phrase this in one sentence, I would definitely say that 2025 was a maturity refinancing year. So if we take it back all the way to 2019, during COVID times, we saw that the cost of borrowing was almost free. There was a lot of opportunities for investors to acquire or even build homes. Inflation started to rise. So home prices in specific states, such as Florida, rose exponentially. I mean, you purchased a house, sorry, in 2020, um, and today it's worth 3 to 5 times its acquisition price. So some markets like Florida had real demand. And on the other hand, we saw investors that built and built in other markets that was not as high demand as expected and are now faced with a little bit of too much supplies. Cap rates are going down, vacancies rising. So they're offering concessions to lease up the building, but cash flow is still not performing. So that was a little bit of 2019 to 2024. And then moving forward to 2025, all these loans had maturity dates. And I believe that 2025 was the year that we saw a lot of investors refinancing their 2020, 2022 loan, but with different market conditions. So those owners were faced with three different options. So the number one is they sold the property if the deal no longer penciled out at a higher cost of borrowing. The second would be they would cash out, refinance at a high leverage, but interest rates were a little bit higher, but cash flow supported it. Or the third option would be refinancing at lower leverage if the rents did not grow as much as home prices. So this whole thing created a forced decision-making market where sponsors had to react fairly quickly. And as we moved forward towards mid 2025, we started seeing inflation ease down and then interest rates lowered down. So we saw in September a 25 basis points interest rate reduction. In October, we saw another 25. And about a month ago, we saw another 25 basis point spread reduction. So what does that mean? That means inflation is easing down. And actually, this morning, the CPI report came out today with a 2.6% year over year, which is below expectations. So, what does that mean? Inflation is easing down, interest rates are falling. What does that mean for 2026?